When starting off in cryptocurrency investing, it can be quite an obstacle trying to adapt coming from an already existing financial market background, such as the stock market or Forex market. Even if you have not come from already trading another market, many of us have pre-assumptions of how markets work through the media, word of mouth, and the internet. All three have their differences, but cryptocurrencies are a lot closer related to the absolute basics of the stock market compared to the Forex market, where the difference is a bit more obvious. Let's start with Forex, also known as FX. FX trading is predominantly margin-based, which means you never really own the currencies you buy. You're technically borrowing money to increase your buying power and control a much larger position than your account size would allow. This means the capital in your account is used as a deposit and guarantee should your leveraged position go against you and it needs to be liquidated. When you actually place a trade in Forex for a currency pair like GBP USD, the pound versus dollar, you are never actually buying the physical currencies. You are essentially betting on the outcome of the currency going either up or down. You do not have to worry about storing currency or signing any contracts. You just speculate on its movement from the comfort of your online platform or phone. FX volatility usually stays well below 1% on any given day, except for news events. The market trades over $5 trillion a day and is extremely liquid. Prices measured in increments called pips. Buy and sell orders are almost instant. Price moves mostly from technical analysis and usually is completely logical in respect to these levels, unless a surprise news announcement happens. Now let's compare crypto and stocks, as they're slightly similar to each other and we can identify the differences as we go on. Whilst the ability to margin trade both stocks and crypto is possible, this is more optional and only in specific cases. This means you can only buy what your current account balance can afford. Margin trading crypto in particular is a one-way ticket to going broke. The market is still too young to have the liquidity like the FX market, meaning if price spikes against you, there may not be a buyer available to clear your sell order, leaving your trade to continue running in further loss, with money you do not have in your account. When you invest in the stock market, for example in Apple, and let's say in this scenario, Apple's trading price is $50. This means the price for one share in Apple is $50. So price moves in a more recognizable format compared to FX and just sticks by moving up or down in dollars, euros, or pounds. In crypto, if the price of a coin is $50, this means to buy one coin it will cost you, just like stocks, $50. If you wanted 7 shares of Apple, it would cost you $350, as you're buying 7 of the shares worth $50 each. Vice versa, 7 cryptos worth $50 each would cost exactly the same. Unlike FX, investing into shares of a company means you actually own a piece of that business now, and technically as a shareholder in the company. This is usually represented in the form of a printed certificate after investing, whilst buying crypto from an actual exchange means you genuinely own those coins. Seeing as these are digital currencies, you cannot own them physically, only in their true digital form. However, this also brings the responsibility of protecting and securing these coins online as if they're currency in physical form. Technical analysis also works with stocks to some extent. However, the real shifter of price is news announcements on quarterly or annual reports for the specific business you have invested in. Cryptocurrencies work on a combination of the two. Technical analysis can work very accurately once you know how to use it for specifically cryptocurrencies, as FX technical analysis is not valid with crypto charts. Technicals alone can cause price breakouts of 50% and beyond. Yet due to the market being so young and unregulated, news announcements are also used as manipulation days for the players in the market with large volumes of crypto that can shift the price up or down. One last difference with crypto compared to other markets is the volatility is so frequent that it's actually much more effective to hold during large falls in price, rather than alter your entire investment bias like you would do in Forex. It's going to be very different to what you're used to, and it may seem scary at times. That's what I'm here for, guiding you every step of the way. See you in the next lesson.